Hello and welcome to our channel. This is our 5th video in our recent series looking at how to invest so that crashes don't matter. Last time, we looked at the elegant and durable idea of using 100 minus your age as a great potential rule of thumb to get your mix of aggressive versus defensive investments roughly right, big picture and over your lifetime as an investor. To recap very quickly, one of the key things you're going to want to get right when you arrange your financial affairs is to trade off risk versus reward. And a key feature of investing in financial markets is that assets which might provide you with a higher percentage return tend to be riskier and have the potential to lose you lots of money in a crash. And at the other end of the investment spectrum, things that are inherently safer will tend to give you lower investment returns. This has been particularly problematic in recent years, with real returns on defensive asset classes like cash and bonds at historically low and even negative levels in real terms, that is, after inflation. We've looked at how the whole idea of 100 or 110 or 120 minus your age can help with this problem. So please do check out our last video if you want to understand this all in some more detail. And this is one of the most helpful ideas when it comes to investment, so really useful to understand it if you want to get your finances sorted. I ended that last video by saying that next time, i.e. today, we look at the idea in a bit more detail and crucially cover a couple of other well-known big picture approaches to investment, if only to contrast them with the idea of 100 minus your age. And these two big picture approaches are something called the 60-40 portfolio and another that I would describe as the market purist approach of investing 100% in the stock market or in shares. So today, let's look at each of these in turn, given how helpful I think it is to understand them both. This whole idea of 100 minus your age is arguably a more advanced and nuanced version of something called the 60-40 portfolio, which has been around since the 1950s. 60-40 refers to a portfolio holding 60% in shares and 40% in bonds. And by the way, we'll look at bonds in more detail in future videos. But for now, it's enough to just understand that a 60-40 portfolio is 60% shares and 40% bonds. So rather than have to bother to change your allocation every 5 to 10 years or so, which is the approach that you take if you use 100 minus your age, we looked at in the last video, the idea of 60-40 was that all you need to do is have 60% in shares and 40% in bonds for your entire investing life. This was one of the best known and most successful set and forget approaches to investment of the last many decades. The idea originally came primarily from Harry Markowitz and William Sharpe, both of whom received the Nobel Prize for Economics for their work on modern portfolio theory. The 60-40 mix was a solid approach to investment for roughly 6 decades from the 1960s onwards. A 60% exposure to the stock market provided good returns, and the 40% in bonds protected the downside and reduced your losses overall when the stock market crashed. So from 1961 to 2021, this approach averaged around 9.3% returns per year, but with lower volatility and a lower risk of loss than just investing in the stock market. This was a really great outcome for those who used the 60-40 approach. As we've seen many times, that sort of return, so more than 9% per annum for many, many years, can and will deliver a life-changing outcome for you. And as a result, many billions was invested like this in the US in particular for many decades. And the reason that 60-40 worked so well was because for much of that time, bonds and shares were what is called negatively correlated. And that means that when shares fell, bonds went up. And this meant that the bond component of the 60-40 portfolio could protect an investor really nicely during stock market crashes. In recent years, however, bonds and shares have become positively correlated, which means that the strategy has stopped working, and there are concerns that it may not be as successful in the future as it has been in the past. Usually, if the stock market crashes, there is a phenomenon known as the flight to quality, which means that worried investors sell aggressive shares to buy defensive bonds. And this, of course, bids up the price of those bonds and is why the two assets can often be negatively correlated, and bonds can historically protect you from stock market losses. Crucially, however, this stops working when investors expect interest rates to rise. Bond prices fall when interest rates rise. And with the higher inflation that we've seen in recent years, investors all over the world have expected higher interest rates, which has caused many bond prices to fall, and often a long way. This is why many market commentators fear that the 60-40 portfolio is unlikely to work as well in future as it has in the past. And because of this, you may be better served by the more nuanced idea of 100 minus your age, and by using a variety of aggressive and defensive investments, not just shares and bonds. And we'll cover all of this in more detail in future videos. The other approach that I think is really important to look at in today's video, though, is what you might call the market purist approach of investing only in shares. So there are many sensible financial market commentators who have suggested that you may only need to own the market, by which they usually mean the US market, and specifically that will usually mean the S&P 500. So that's to say that you don't need to think about aggressive versus defensive investments at all. You can just buy aggressive shares throughout your entire investing life. One such individual promoting the idea is Warren Buffett, arguably the most famous investor in the world for the last many decades. Buffett, and plenty of others like him, are often on record suggesting that all someone need do when it comes to investment is simply buy the stock market each month, every month, for many years. This stance is particularly popular at the moment given how long and how strong the run in US shares has been. And a key point to make about this approach is that it works particularly well if you are very wealthy, like most of the people who recommend this approach. To explain this, as we've seen in a number of our previous videos, a 50% market correction in a stock market crash for a 60-year-old with £1 million will be far more damaging and consequential than it will be for a 30-year-old with £10,000 who has a lifetime of investment ahead of them. For the 60-year-old in this example, this sort of drawdown could be catastrophic and certainly entirely horrible and stressful to live through as they approach retirement. But another person to consider here is someone worth, say, £10 million. If you're lucky enough to be that wealthy, you would still have £5 million in your investment account after a 50% market correction if you were 100% allocated to the stock market. And as should be more or less obvious, this will be far less catastrophic for you and for your life overall than a 50% correction for someone with only £1 million. Very wealthy people can take the risk of being almost entirely exposed to the stock market, given that they will still have more than enough to live on, even through a large financial crash or crisis. To put it another way, they can ride out any serious stock market volatility until the market goes back up again, without it having much of an impact on their day-to-day lives in the real world. And of course, if they're psychologically strong and really understand the stock market at least. This is why very wealthy folks like Warren Buffett can tend to be such market purists. If you are a very high earner, start to invest early enough in your life and make strong returns, you do have a good chance of ending up with several £1 million. If you manage to achieve this, you can then afford to continue to take more risk with your portfolio because a big stock market correction is unlikely to affect you in terms of your ability to cover the key costs of living your life. And this is clearly a wonderful position to be in. I would argue that most people, even including people who you might consider actually quite wealthy, will want to ensure they have the right sort of mix of aggressive and defensive investments over time, given the effect of a big stock market crash could be far more problematic. I hope this makes sense. So we've now looked at the challenges associated with a traditional 60-40 portfolio, and we've also looked at the fact that a market purist approach of owning only shares will expose you to a good deal of volatility and is therefore probably only a good idea if you're very wealthy and pretty psychologically strong too. You might argue, therefore, that some kind of 100 minus your age approach is a kind of Goldilocks option which may suit the majority of people. In plain English, what this means is that you'll split whatever you can afford to invest each month into aggressive versus defensive investments based roughly on your age, and only after you've paid down any expensive debt and saved up a rainy day pot, of course, ideas we've looked at in our previous videos. If you're already retired, 100 minus your age can help you work out roughly how to allocate your existing pot to those two categories of investment, i.e. aggressive and defensive. Once you've got to grips with this idea overall, you then have two broad decisions to make. First, whether to use 100, 110, or even 120 minus your age to calculate how to split your investments each month. And please see our most recent video if you want a reminder about this point and the difference between 100 minus your age and, for example, 120 minus your age. Secondly, and more or less obviously, you will need to think about the specifics of which aggressive and defensive investments you might use, having made that calculation. Deciding whether to use 100, 110, or 120 minus your age to calculate your split will depend on your own personal circumstances. These would include, firstly, how comfortable with risk versus how risk-averse you are overall. If you're inherently conservative, then you might use 100 to make your calculation. If you have the mental strength to endure periods where your investments could be deeply underwater, then you might use 120 as the basis for your calculation. Be warned, however, relatively few people have this mental strength, a topic to which we will return. Secondly, how much you earn. And this is related to the last point. Although this is by no means always the case, people who earn more or who have significant wealth already tends to be more comfortable with risk because they can afford to be, as we've seen. The more surplus you have over and above funding life's essentials, the more ambitious you can afford to be with your investments. If you're a high earner, you might be more inclined to use the 120 number as against the 100 number. That having been said, this will all be a matter of personal choice. There are plenty of wealthy people who are inherently conservative when it comes to their wealth, a decent number of whom will tell you that this is why they became wealthy in the first place. And thirdly, you'll want to think about how old you think you will work to until you wish to retire. I know people who made enough money to retire in their 30s, and I know people who are so passionate about what they do that they're still loving their work and invariably highly paid in their late 70s and beyond. The longer you're gainfully employed and earning a decent income, the longer it will be before you need to rely on your investments to sustain you. And this means, all other things being equal, that you can afford to invest in more aggressive assets for longer and might therefore use 120 rather than 100 in your calculations here when you're thinking about 100 minus your age. That having been said, if you use the 120 number, bear in mind that this implies you could still have no less than 50% of your money in higher risk assets at the age of 70. This is perhaps quite a big call unless you're fairly wealthy and comfortable with risk. As with so many things in investment, there really is no one-size-fits-all right answer here. But the whole concept of 100 minus your age can give you a solid, big-picture idea of how you might get the balance of investments roughly right over time to increase your chance of making solid investment returns and minimize the risk of a large loss. If you take this approach, you probably need only review your investing plan every 5 years or so, perhaps on the occasion of your 30th, 35th, 40th, 45th, etc. birthdays, as I explained in our last video. Every 5 years or so, you might sit down and spend an hour or three ensuring that your financial arrangements are sensible and preferably on autopilot, and then forget about it for another 5 years. This whole approach can give you real peace of mind and makes things a great deal less burdensome in terms of admin than the approach so many people take, chopping and changing all the time. 5 years is also a period of time which will give your investments the best chance to be making you a positive return. Another rookie mistake I see all too often is people investing in a fund which then has a negative few months or even a few weeks, who then start wanting to sell out of that fund and move into another one that is doing theoretically better. And this goes back to the point I've made in the past, where I said that financial products are one of the few things that people tend to buy when they're expensive and sell when they're cheap. Giving up on an investment fund after a few months, or even frankly after a few years, and switching to a fund that has been doing better is one of the many reasons most investors return less than the market does. Sticking to your guns for long periods of time is really important, particularly if you're buying every month and pound cost averaging anyway, which means that you will be buying any of your investments which are down more cheaply each month whilst they're down, of course. As John Stepek, Bloomberg journalist and former editor of Money Week magazine, has put it rather brilliantly in one of his articles, there are many roads to ruin in the markets, some of them longer than others, but one surefire way is to set out as a buy and hold investor and then attempt to turn into a market timer during a bout of market panic. This will do more damage to your portfolio than following one approach or the other. Or, as the great and late Charlie Munger, Warren Buffett's right-hand man for many decades, has put it, if you're not willing to react with equanimity to a market price decline of 50%, you're not fit to be a common shareholder and you deserve the mediocre result you're going to get. It's crucial to do whatever you do for the very long run and stick to your guns. Some version of 100 minus your age applied to how you invest can help you work out whether you are broadly in the right mix of things and on the right track. This approach will make you far less likely to make the mistakes that so many people make that are born of panic and silly headlines from a press that focuses 99.9% of its attention on the bad things that only happen 0.1% of the time, again, as we've seen in previous videos. So, if you've now worked out how much you can afford to invest each month and roughly how to allocate that money to aggressive versus defensive assets, the final piece of the jigsaw puzzle is specifically which investments you might consider. And we'll look at this topic in more detail next time. As ever, if you want to ensure that you're one of the first to see these videos when they're published, please do click the subscribe and bell buttons. And if you'd like to hear more from me, please do feel free to connect with me on any or all of LinkedIn, Facebook, and Twitter or X. Until next time, I wish you the very best.